All right, the brand new 2026 federal income tax numbers are officially out. And in this breakdown, we're going to get into exactly what they mean for your wallet. And trust me, these aren't just little tweaks. These changes will directly impact how much you owe the IRS. So let's get right to it.
Okay, so let's unpack this. The new tax tables give us wider brackets and bigger deductions. Sounds great, right? Well, yes, but the real story is kind of hidden in the fine print. See, the way these adjustments are calculated has changed, and that means the tax relief might not be quite as good as it looks at first glance.
Before we get deeper into how federal tax brackets affect your refund or liability this year, let's talk about something every business owner dreads but cannot ignore: properly filing your tax forms. If you're running 1099 contractors, issuing W-2s, or handling payroll forms, one tiny mistake, one incorrect TIN, one missed deadline can cost you penalties, headaches, and hours of buried paperwork. That's exactly why you don't want to be fumbling around with outdated tax software or manual spreadsheets when it's time to e-file. You need an IRS-authorized filing platform that's fast, accurate, and compliant with all federal and state requirements. That's where Tax 1099 comes in. Tax 1099 is an award-winning IRS-authorized e-file platform that lets you quickly submit all your 1099s, W-2s, 94BEX forms, ACA forms, and more without the tax season stress. The guided workflow helps you create, validate, and submit forms in minutes, and its AI-assisted checks flag issues before you hit submit.
Prices start as low as just a few dollars per form, and it integrates with QuickBooks, Excel, Xero, and other accounting tools you already use. If you want to make this tax season as painless and error-free as possible, especially with these 2026 brackets and standard deduction changes, use the link in the description to get started with Tax 1099. It's the easiest way to file your IRS forms on time without the usual stress.
So first things first, let's get into the good news. We're going to walk through the two biggest updates you'll see: the new and improved tax brackets and the higher standard deductions for the income you'll be earning in 2026.
Here we go. For 2026, the IRS is sticking with the same 7 tax rates we're used to, everything from 10% all the way up to 37%. The real change, though, is that the income levels for each of those brackets have all been pushed higher to account for inflation. You can see it right there. Take the 12% bracket for married couples. It now goes all the way up to over $100,000. That gives a lot of families a little more breathing room before they jump into the next tax rate.
Okay, this is probably one of the most important things to get right about our tax system. So listen up. Your entire income is not taxed at your highest rate. It's just not how it works. It's a tiered system. Think of it like filling up buckets. You fill up the 10% bucket first, then you start pouring into the 12% bucket, and so on. So you only pay that top rate on the last few dollars you earn, not on everything.
Now, beyond the brackets, let's talk about the standard deduction, because this is where a lot of us really feel the impact. For single filers, this has been bumped up to a pretty solid $16,100 for 2026.
And if you're married and filing jointly, well, that number gets even bigger. It's now a hefty $32,200. I mean, think about that. That's how much income you can earn before you owe a single penny in federal income tax. And finally, for heads of household, that deduction is now up to $24,150. So no matter how you file, the big takeaway is this: these increases shield more of your money right off the top before the tax math even begins.
Okay, so seeing numbers on a slide is one thing, right? But what does this actually mean for your tax bill in the real world? Let's run the numbers for two different families to really see how this plays out.
Let's start with a married couple. They're both under 65, filing jointly, and they have a gross income of $150,000. First, we take out their new standard deduction. That's $32,200. That leaves them with a taxable income of $117,800. Now we apply those 2026 brackets. Part of it's taxed at 10%, a bigger chunk at 12%, and the rest at 22%. You add it all up, and their total federal income tax comes out to $15,340. In this example, it's the perfect way to show the difference between two really important terms. Their marginal tax rate, that's the rate on their last dollar earned, is 22%, but their effective tax rate, the actual percentage of their total income they paid in tax, is just a little over 10%. See, it's a huge reminder that you never ever pay your top bracket rate on all of your income. But wait, it gets even better. If you're 65 or older, in 2026, seniors don't just get the standard deduction, they also get an extra $1,650 each. And on top of that, there's a temporary bonus deduction. It's part of a provision sometimes called the OBBB, and that's worth another $6,000 per person. It's a pretty big deal, though it does start to phase out if your income gets too high. So let's run those exact same numbers again. $150,000 income, but this time our couple is over 65. They get that big standard deduction, plus the 2 age-based add-ons, plus the full bonus deduction. Their total deductions just explode to $47,500. After you run that through the brackets, their final tax bill is just $11,974. And here it is, the bottom line. On the exact same income of $150,000, the senior couple pays almost $3,400 less in federal income tax. That is the incredible power of these extra deductions. They can easily save you thousands of dollars.
So far, this all sounds like pretty great news, right? Wider brackets, bigger deductions, what's not to love? But remember that catch we talked about at the very beginning. Well, here's where we get into the nitty-gritty. See, back with the Tax Cuts and Jobs Act of 2017, the government changed how it measures inflation for tax purposes. And since then, the system's been tied to something called chain CPI. Now, unlike their traditional way of measuring inflation, chain CPI basically assumes that when prices go up, you change what you buy. So if steak gets crazy expensive, it assumes you'll just switch to chicken. This substitution effect means it almost always calculates inflation as being lower than what you might actually be feeling at the grocery store.
In this chart, it shows you exactly what that means in the real world. Because chained CPI grows more slowly, our tax brackets today are actually about 2 to 3% narrower than they would have been under the old system. You can see right there, if we had just stuck with the old way, the top of the 12% bracket for married couples might be closer to $103,500 instead of where it is now.
This whole thing creates a quiet, kind of stealthy tax hike that experts call bracket creep. What it means is, even if your salary only goes up enough to match the actual cost of living, you can still get pushed into a higher tax bracket. You're not actually any richer, your money doesn't go any further, but you still end up paying more in taxes. It's a slow-motion tax increase.
Now, while that whole inflation thing is, well, it's kind of baked into the system, there are absolutely parts of our financial lives we can control. And a huge part of smart tax strategy is just understanding that not every single dollar that comes your way is actually considered income by the IRS. So let's look at some powerful income streams that are completely tax-free.
Let's just do a quick run-through with some of the big ones. First, financial gifts. In 2026, you can get up to $19,000 from any one person completely tax-free. Most inheritances, also not taxed at the federal level. Got a Roth IRA or a Roth 401k? Qualified withdrawals from those are 100% tax-free. And finally, payouts from life insurance policies and the interest you earn from most municipal bonds, also exempt. Alimony is a really interesting one. The tax rules did a complete 180 here, and it all depends on one single date. For any divorce finalized before January 1st, 2019, alimony is taxable income to the person who gets it. But for any divorce finalized after that date, it's not considered taxable income at all. It's a tiny detail with a huge financial impact. And that really gets to the heart of it, doesn't it? Understanding these non-taxable income sources is just a core part of building a tax-smart financial plan. It's not always about what you can deduct. Sometimes it's about structuring your finances so some of your money is never even on the IRS's radar to begin with.
So let's bring it all home. The 2026 changes, they definitely bring some nice perks, bigger deductions, wider brackets, and a really significant boost for seniors. But that underlying formula, that chain CPI, is slowly but surely causing more of our income to get taxed at higher rates over time. And that brings us to the final crucial question we all have to ask. Are these annual tax adjustments really keeping up with the reality of our expenses?